If you are 50 to 65 years old and you've accumulated around $2 million, you're in a very different position than most Americans. You've done the hard part, you've saved, you've invested, you've avoided lifestyle creep. But here's an uncomfortable truth. Building up $2 million in your investments and living off $2 million are two completely different skill sets. And most people, even smart, successful people, have never been taught how to make that transition safely. Today, I'm going to show you lessons in how to turn a $2 million portfolio into a retirement paycheck without running out of money. We'll walk through 3 risks you'll face as a retiree or someone planning on retiring and the solution. Ready? Let's jump in. Number 1, first, we have to address the core problem. While you were working, your financial life was structured around accumulation. Contribute to the 401k, invest in growth, ride the market, ignore volatility for the most part, stay aggressive for the most part. And you know what? That works beautifully when you're adding money every year into your accounts and maybe when you're a bit younger. And think about it. Even if the market is experiencing a short-term decline, you get to buy stocks at a discount during that accumulation phase. But retirement, or approaching within 5 years or so of retirement, totally flips the math. Now you're not planning to contribute to your accounts. You're having to figure out withdrawing. Now volatility matters. Now sequence of returns matter. Now taxes matter. Now timing matters. Retirement is not just an investment problem. In fact, that's only one part of it. It's actually, in large part, a distribution problem. And many portfolios are just not designed for sustainable distributions that you can live off in your retirement without running out of money. Number 2, we've got to talk about a common misconception, and that is using rules of thumb as your financial plan. For example, you've probably heard of the 4% rule. It states withdraw 4% of your portfolio, adjust for inflation, and you'll probably be fine. But here's what that rule assumes. Predictable returns, no planning around downturns or simply bad timing, no guardrails, and no tax optimization. The 4% rule is just what we called it. It's a rule of thumb and not a retirement plan. And for someone with $2 million, that difference can be the difference between having plenty in retirement and waking up one day asking yourself what happened. All right, number 3 on our risks, and this is one of the biggest hidden retirement risks, and that is sequence of returns. What makes this risk so scary is that it's a risk you can't control. Sequence of returns risk simply means that when you retire, what kind of returns does the market give you for the next few years? To put it plainly, what is the sequence of stock market returns as you approach and transition into retirement? Here's another way to think of sequence of returns risk. If you retire during a bull market, great, lucky you. The market is going up and your portfolio is increasing at the most sensitive time for your financial plan, the beginning of your withdrawal phase. Conversely, if you retire during a downturn, you're withdrawing income at the same time your portfolio is going down. That means you're selling shares at depressed prices, and those shares never get a chance to recover. Sequence of returns risk means you can have 2 retirees with the same average return over 20 years. One retires in a bull market, one in a downturn. You can end up with 2 potential dramatically different outcomes. And the worst part of this is it all comes down to luck. No one can predict or control the sequence of returns you get. Now, if this part of the video scares you, there's good news. I'm going to show you how we fix this problem. Ready? Let's do it. So, how do we fix the problem of uncertainty with sequence of returns throwing a dart against a dartboard method of a rule of thumb like the 4% rule, and the complexity of moving from an accumulation mindset to a withdrawal mindset? Well, we stop thinking of your portfolio as one giant pile of money, and we start thinking of it in terms of a paycheck system. When I work with people in the retirement age range, I like to think of your portfolio as a business that pays you. Kind of like when you were employed and you got a paycheck every 2 weeks. Thinking of your portfolio as a business helps frame things correctly mentally. For example, what is something that all businesses should have? Cash reserves to see them through hard times. The same works for your portfolio. The way to manage the risk we discussed earlier is to have at least 1 to 3 years, maybe more, of spending in stable investments. These might include, but are not limited to, cash, high quality short-term bonds, treasuries, very conservative fixed income, or a combination of all of these. This stable portion of your investments is there to serve 3 purposes: manage risk in short-term volatility, provide yield or income on that money, and provide stable liquidity during long-term market downturns. Think about it. If the economy goes into a recession and the market takes 1, maybe 2 years to recover, for example, you have enough stable money set aside to see you through that downturn without having to sell your stocks at depressed prices. With the portion of your money allocated to growth and or income, you can invest in diversified, high-quality investments. Now, with this strategy, your portfolio is designed to manage risk, grow, and have structure that can provide you a retirement paycheck over the course of decades. Importantly, if you happen to retire during a down market, you can take back control by being prepared for that ahead of time. Now, there are many aspects to managing a portfolio that has $2 million or more or less. There's tax structure, Social Security, balancing the right mixture between conservative and growth-oriented investments. And that's exactly what we help our clients do at Shrum Private Wealth Management. If you're between 50 and 65 years old, you've accumulated at least $1 million, you're within 10 years of retirement or retired, and you want to work with someone to design a retirement paycheck system from your investments, then you're exactly who this conversation is for. Below this video, there's a link that you can go and apply to work with us. We specialize in helping pre-retirees and retirees turn portfolios into sustainable retirement income systems and take that burden off of your shoulder. If that sounds like what you're looking for, you can apply below. And if this video was helpful, please like and subscribe. Thanks.
The content provided is for general information and educational purposes only and should not be considered a recommendation of any particular strategy, investment product, or investing advice of any kind. Content is not intended to be and should not be construed as legal or tax advice and or a legal opinion. Please consult a financial professional for your specific situation. Investing involves risks, including the loss of the entire principal. Past performance does not guarantee future results. The views and opinions expressed here are of the author and do not necessarily reflect the opinion of Shrum Private Wealth Management, LLC. Investment advisory services offered through Shrum Private Wealth Management, LLC, an SEC registered investment advisor.